Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on a Friday, June 23rd, 2023. And welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's get to that. Our first story takes us to the International Monetary Fund, where a shift in perspective on the regulation of cryptocurrencies seems to have occurred. Just a few months ago, the IMF suggested the possibility of banning cryptocurrencies. However, they have now expressed a different point of view. And boy, their timing is interesting, isn't it? Let's find out more. The IMF recently expressed its views on the regulation of cryptocurrencies. The organization believes banning crypto might not be the most effective way to manage the risks associated with them. This perspective comes just a few months after the IMF suggested banning as a possible approach. The IMF's change in stance is based on the understanding that a complete ban would also prevent countries from reaping the benefits associated with crypto. The IMF's comments were made in context of the growing interest in central bank digital currencies in Latin America and the Caribbean. The organization believes that instead of banning cryptocurrencies, the region should focus on understanding why people are drawn to them. This includes addressing the unmet needs of citizens for digital payments and improving transparency by including cryptocurrency transactions in national statistics. Countries like Brazil, Argentina, Colombia, and Ecuador were among the top 20 countries for global adoption of cryptocurrencies in 2022, and as such, they were specifically mentioned by the IMF. Interestingly, Argentina banned the use of cryptocurrencies in May of that year. It's believed that they did so at the behest of the IMF in exchange for loan considerations. The IMF's comments suggest a shift in their perspective, recognizing that outright bans might not be the best approach. The discussion around CBDCs is gaining momentum worldwide. The Bahamas and Nigeria have already issued one, and the EU is on track to release a draft law on the digital euro this month. China's had one in beta for quite a while now. Editor's note: if Nigeria and China are going to be any kind of example, the population just isn't interested in CBDCs. Less than 0.5% adoption rate in Nigeria. So it makes sense that they're going to go back to the drawing board and start looking for the characteristics of crypto to steal for their digital fiat. The IMF's report also highlighted the different approaches taken by the governments in Latin America and the Caribbean in addressing the adoption of cryptocurrencies and CBDCs. For instance, Bitcoin has been accepted as legal tender in El Salvador since September of 2021, and the Bahamas was the first country to launch its own CBDC, the Sand Dollar, in October of 2020. The IMF believes that if CBDCs are well designed, they can strengthen payment systems' usability, resilience, efficiency, and increase financial inclusion in the region. The organization has often made public statements against countries adopting crypto as legal tender. However, the recent comments suggest a more nuanced view, recognizing the potential benefits of digital currencies while also acknowledging the need for effective regulation and transparency. Moving on to our next story, the U.S. Securities and Exchange Commission has made an interesting decision regarding a fine imposed on the crypto lender BlockFi. Let's take a closer look. So, the SEC decided to hold off on collecting a $30 million fine from BlockFi. This decision was revealed in a court document filed on Thursday. The remaining $30 million is the $50 million penalty that BlockFi was supposed to pay. The penalty was part of a settlement for charges against BlockFi for not registering its crypto lending product with the SEC. BlockFi agreed to the settlement in February of 2022, but then filed for bankruptcy in November after the collapse of FTX. The SEC said that its claims should be considered as general unsecured claims in the ongoing Chapter 11 bankruptcy proceedings. However, it has agreed to delay the payment to maximize the amount that can be distributed to investors and to avoid any delay in such distribution. Sasha Hodder is the founder of Hodder Law, a firm that specializes in crypto law. According to Hodder, the SEC was probably one of the first creditors that BlockFi would have had to pay off. That's with the customers at the bottom of the list. In May, a judge from a New York bankruptcy court said that BlockFi customers could be repaid $300 million from funds held in custodial wallets on the platform. While they have presented a reorganization plan to the court, BlockFi stated that $1 billion in claims against FTX and Alameda will be the largest driver of fund recoveries for customers and creditors. Our third story takes us to the perilous situation of Prime Trust Bank. Recent developments have put the company in a difficult position. Let's uncover the details. BitGo recently announced the termination of its planned acquisition of fintech infrastructure provider Prime Trust. This decision was made 2 weeks after BitGo publicly disclosed its non-binding letter of intent to acquire Prime Trust. BitGo said that this decision was not made lightly. The deal was expected to provide BitGo with access to Prime Trust's payment rails and cryptocurrency IRA fund, as well as the opportunity to broaden its wealth management services. However, the deal was called off. Rumors suggested that a cease-and-desist order Prime Trust allegedly received from Nevada state regulators might have been the reason. So what happened is, on that same day, the Nevada Financial Institutions Division announced that Prime Trust could not meet all customer withdrawals. The regulator had been monitoring the company's solvency ahead of the planned acquisition by BitGo, so that explains why they were looking. The regulator said that Prime Trust failed to safeguard assets under its custody and breached its fiduciary duties to its clients. That put them in violation of Nevada trust laws. The regulator also issued a cease-and-desist order to the company, ordering it to stop accepting fiat and cryptocurrency from existing and new clients for custody purposes. In response to the order, Prime Trust halted deposits and withdrawals of both fiat and crypto. This action affected other companies as well, for instance, Stably. They are a fiat on-ramp service that relies on Prime Trust as its regulated custodian. They were forced to pause some services and operations. CoinMetro also announced that it was currently unable to process new USD transactions as a result. However, not all companies were affected by Prime Trust's situation. TrueUSD, the issuer of the TUSD stablecoin, announced that it had no exposure to Prime Trust and maintained multiple USD rails for minting and redemption. TrueUSD assured its users that all of their funds were safe with TUSD. So this kind of thing happens a lot after a collapse. Every company comes out of the woodwork to claim they have no exposure. Sometimes that's true, sometimes it's not, but all in an attempt to reassure their customers so they don't yank their funds from the platform. Now, Prime Trust faced significant challenges in recent times, including reports of laying off a third of its staff in January. Furthermore, Prime Trust was embroiled in a scandal in Oregon last year. It was revealed to be the source of a $500,000 contribution to the state Democratic Party. This contribution was later traced back to the former FTX executive Nishad Singh. On June 13th, court documents revealed that Bank, the payment subsidiary of Prime Trust, filed for bankruptcy protection in the United States. The bankruptcy filing by Bank disclosed assets amounting to $17.72 million and liabilities of $5.4 million. This development occurred shortly after BitGo expressed its intent to acquire Prime Trust on June 8th. It is yet to be determined if the timing of this bankruptcy filing had a negative impact on BitGo's proposed acquisition of Bank's parent company. Now for our next story, we turn our attention to the Commodities Futures Trading Commission and their involvement in 2 significant cryptocurrency scam cases. Let's dive into the details. The CFTC has recently been involved in 2 significant cases related to crypto scams. The first case marks the CFTC's first romance scam case. It involves a California-based company named JustBe International Auctions and its CEO Kunwen Zhu. The second case is against a New York resident, William Ku Ichoika, who was allegedly involved in a fraudulent commodity pool scheme. In the first case, the CFTC found that JustBe International Auctions misappropriated $1.3 million in customer funds that were intended for digital asset trading. The company and its CEO allegedly accepted these funds from at least 29 customers who were led to believe that they were investing in legitimate trading platforms for digital assets and foreign currencies. However, the funds were not used for trading. Instead, Zhu used some of the funds for personal use and then transferred the majority to others who were involved in the scheme. The CFTC alleges the company used solicitors who reached out to customers on social media and pretended to befriend or romance them to convince them to open accounts in the time period from April 2021 to March of 2022. In the second case, the CFTC filed an enforcement action against William Ku Ichoika for fraudulently misappropriating over $21 million from more than 100 participants in a commodity pool. Ichoika promised to use customers' assets to enter into retail foreign currency transactions through a commodity interest pool operating under the name Ichoika Ventures. He promised a 10% return within 30 business days and maintained that participants could easily withdraw or reinvest their funds. However, similar to the previous case, instead of using the funds for trading, Troika used the money for personal use and expenses, to include such things like luxury automobiles and rent payments. This fraudulent scheme ran from 2018 to 2021. In both cases, the CFTC is seeking restitution for defrauded customers, disgorgement of ill-gotten gains, civil monetary penalties, trading bans, and permanent injunctions against further violations of CFTC regulations. In addition to the CFTC's actions, parallel criminal complaints have been filed against both Zoo and Troika by the U.S. Attorney's Office. The SEC has also filed a parallel action against Troika. These cases highlight the risks associated with investing in digital assets and the importance of being cautious when dealing with individuals or companies offering high returns on investments. They also underscore the CFTC's commitment to enforcing regulations and protecting consumers from fraudulent schemes in the digital asset market. Next up, we have some positive news in the crypto world. Crypto.com, a digital asset exchange, has received approval as a virtual asset service provider in Spain. Let's take a look at the development. Crypto.com was recently approved as a virtual asset service provider by the Central Bank of Spain. This approval came after a thorough review of the company's compliance with laws related to financial crimes. With this registration, Crypto.com can now offer its range of products and services to users in Spain. The Central Bank of Spain started a registry for crypto service providers in 2021. Since then, several firms, including Binance and Bitstamp, have registered with the regulator. This move is part of a broader trend in the European Union, where the new Markets and Crypto Assets framework has been finalized. With this new framework in place, regulators in member states like Spain will soon begin implementing new standards and requirements for virtual asset services. Crypto.com CEO is Chris Marszalek. He expressed his satisfaction with the VASP registration. He said that this approval is a clear indication of the company's commitment to compliance and its willingness to work with regulators and public officials. Marszalek believes that this will help responsibly advance crypto and blockchain technology. And this news is significant for the crypto industry. It shows the growing acceptance and regulation of crypto services and traditional financial systems. It also highlights the efforts of companies like Crypto.com to work within the available systems and to comply with their regulations. This could lead to more opportunities for such companies and increased adoption of crypto services by users in these regions. Our final story of the night takes us to the world of high-profile celebrities and a quest for a massive $700 million clawback. It involves Alameda Research and the founder of FTX. Let's uncover the intriguing details. Alameda Research is looking to recover $700 million. This is the amount of money that Sam Bankman-Fried allegedly paid for access to high-profile celebrities and politicians. This money was promised to Michael Keeves and Brian Baum, who are known for their extensive connections. Keeves previously worked as an aide to both Bill and Hillary Clinton. In a court filing, the new management of FTX accused SBF of using the company's funds irresponsibly, treating them as a slush fund. They claimed that Keeves and Baum accepted the money but failed to provide any equivalent value to Alameda. The filing also criticized Bankman-Fried's mismanagement of the exchange, which declared bankruptcy in November. So, Sam was reportedly impressed by a party at Keeves' house in February of 2022. The guest list included a former presidential candidate, actors, reality TV stars, musicians, and multiple billionaires. Within weeks, SBF committed to investing billions in Keeves and Baum's companies. However, the details of what FTX would receive in return were vague. The court filing described the agreement as a cursory list of investment ideas, with no substantial due diligence conducted. Bankman-Fried suggested in an internal note that the company could consider endorsements with their friends, work with them on democratic politics, and invest in them. The filing also highlighted that Bankman-Fried failed to clearly define Baum's role, whether as an FTX employee or as a third party. The transfers of $700 million from SBF's companies to Keeves and Baum's were alleged to have been signs of fraud under bankruptcy law. These signs included concealment, inflated value, and timing. The transfers were made when FTX was on the brink of insolvency. K5 Global is a company founded by Keeves and Baum. In a statement provided to Reuters, a spokesperson for K5 said they believed Sam Bankman-Fried was legitimate and they were entering a fair and long-term, mutually beneficial business relationship. So, what happened? Here's a summary of what we covered. We began by discussing a significant shift in perspective from the International Monetary Fund regarding the regulation of crypto. Previously, the IMF suggested the possibility of banning cryptocurrencies. They have now expressed a different view. The IMF believes that a complete ban may not be the most effective way to manage the risks associated with cryptocurrencies. Instead, they suggest focusing on understanding why people are drawn to these digital assets and addressing the unmet needs of citizens for digital payments. This change in stance reflects the IMF's recognition of the potential benefits associated with cryptocurrencies and the need for effective regulation and transparency. And make no mistake, I am in no way interested in seeing a CDBC come to light. But if we are saddled with one, I hope they at least make a good faith attempt to understand and replicate as many of the advantages of crypto as possible. We delved into a decision made by the SEC regarding a $30 million fine imposed on crypto lender BlockFi. The SEC decided to hold off on collecting the fine as BlockFi has declared bankruptcy. This decision aims to maximize the amount that can be distributed to investors and to avoid any further delay. Our attention then turned to the perilous situation of Prime Trust Bank. The planned acquisition of Prime Trust by BitGo was terminated due to regulatory concerns. The Nevada Financial Institutions Division issued a cease-and-desist order to the company. This order halted deposits and withdrawals, affecting not only Prime Trust but also other companies reliant on its custodial services. We also explored the involvement of the CFTC in two significant cryptocurrency scam cases. The CFTC took action against JustBe International Auctions for misappropriating customer funds intended for digital asset trading. Additionally, they filed an enforcement action against William Ku Ichoika from New York for fraudulently misappropriating millions from participants in a commodity pool. On a positive note, we shared the news that Crypto.com has received approval as a virtual asset service provider in Spain. And finally, we uncovered an intriguing story involving Alameda Research and Sam Bankman-Fried. Alameda Research is seeking a massive $700 million clawback, alleging the money was paid for access to high-profile celebrities and politicians without providing equivalent value to Alameda. This story adds a touch of intrigue and raises questions about the use of company funds and the relationships within the crypto industry. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating or maybe a review. And in the meantime, we'll see you tomorrow night.